In 2019, a tech founder in San Francisco sold $8 million worth of company stock to buy a house. He paid 23.8% in federal capital gains tax, then another 13.3% to the state of California. By the time the check cleared, nearly $3 million of that sale simply vanished. Gone to the IRS, gone to Sacramento, gone forever. The same year, a different founder, same equity stake, same net worth, bought a house of similar value. His accountant wired the funds from a securities-backed line of credit at his private bank. The interest rate was less than 2%. He paid precisely $0 in capital gains tax. Zero. Not a deferred payment, not a special exemption, just a different, and entirely legal, approach to accessing wealth. The first founder followed the rules most people know. The second founder followed the rules most people have never heard of. This is the buy, borrow, die strategy. And understanding how it works changes everything you thought you knew about how the ultra-rich actually pay for their lives. Silence beat after zero. Beat 2. The problem frame. To most people, the formula is simple. You earn money. You pay taxes on it. You spend what's left. That formula works fine at ordinary numbers. A paycheck, a savings account, a modest brokerage account. But it breaks down completely the moment your wealth is denominated not in cash, but in assets. Because here is the trap. When you own an asset that has appreciated significantly, a business, a stock portfolio, real estate, you cannot access that appreciation without selling. And the moment you sell, you create a taxable event, capital gains. Sometimes state tax on top, potentially the net investment income tax, all of it triggered by a single act, converting an asset into cash. This is the tax code functioning exactly as it was written. It taxes transactions. It taxes realized gains. It does not tax unrealized wealth. And that distinction between what is realized and what is unrealized is the crack in the system that the ultra-wealthy have learned to walk through. The solution is not complicated. It is counterintuitive. Instead of selling assets and paying tax, borrow against them. Then, never sell. Hold until death, and let the tax code's own provisions wipe the slate clean. If that sounds too simple to be legal, understand this. It is not a loophole. It is not an exploit someone discovered and quietly passed around. It is the Internal Revenue Code functioning precisely as Congress wrote it, used by people with enough capital and enough advisors to align their entire financial life with its incentives. Here is how it works. Step by step. Silence beat after step by step. Beat 3. The case study. Consider a single asset. A block of stock worth $50 million. The original purchase price was $1 million, invested decades ago by a founder, an early employee, or an inheritor of someone who was. At current valuation, the unrealized gain is $49 million. If the owner sells, the federal capital gains tax alone is roughly $11.7 million. State taxes can push that higher. The net proceeds are closer to $38 million, and that's before the money is spent on anything useful. Now consider the alternative. The owner walks into a private bank, not a retail bank branch with a line for deposits, but a division that serves clients with 8-figure net worths. The owner pledges the $50 million stock position as collateral. The bank extends a securities-backed line of credit. Because the loan is secured by a highly liquid asset, the interest rate is exceptionally low, sometimes under 2% in favorable rate environments. The owner borrows $5 million. That $5 million is not income, it is a loan. The IRS does not tax loan proceeds, any more than it taxes the balance on your credit card. The stock continues to grow inside the trust or the personal account, compounding untouched. The interest on the loan may even be deductible against investment income, and the owner now has $5 million in cash, fully accessible, fully spendable, with no tax bill attached. The following year, the owner borrows another $3 million. Same process, same result. No sale, no taxable event. The stock keeps appreciating. The tax bill never arrives. This is how people with substantial wealth fund their lives without ever triggering the tax events that consume everyone else's income. They don't avoid taxes. They simply structure their cash flow so that taxable events never occur. Beat 4. The mechanism. But there is a question that should be forming in your mind right now. Eventually, The loans have to be repaid, and if the owner never sells assets, where does the repayment money come from? The answer is the third word in the strategy: buy, borrow, die. When the owner dies, the tax code does something remarkable. It grants what is called a step-up in basis. The assets held at death are revalued to their current market price for tax purposes. All of the appreciation that occurred during the owner's lifetime, the $49 million in unrealized gains, the decades of compound growth, is effectively erased from the tax ledger. The heirs inherit the $50 million stock position, but in the eyes of the IRS, their cost basis is now $50 million, not the original $1 million that was paid decades ago. $50 million, as if they had purchased the stock at full market value on the day the original owner died. The estate repays the outstanding loans from its liquid assets. The heirs take ownership of the remaining stock, or more commonly, the trust does, at its stepped-up basis. And when those heirs eventually sell shares themselves, they will pay capital gains tax only on the appreciation that occurred after they inherited it. Multiply this across an entire portfolio, across multiple asset classes, across decades of compounding, and you begin to understand how a fortune can pass from one generation to the next, and then to the next, having funded entire lives of luxury without ever triggering the tax bill that an ordinary person would face for simply selling a rental property. B-roll Q, animated flowchart, asset, loan, step-up, heirs beat 5. The contrast. Now look at what happens without this structure. Imagine the Vanderbilt heirs again, the same family that was once the wealthiest in America. When Cornelius Vanderbilt died, he left his fortune directly to his children. Not through a trust, not through a structured vehicle, with a trustee sitting between the money and the heir's impulses. Directly, personally, his children inherited cash, they inherited stock, they inherited mansions, in their own names, and then they spent it. They sold assets to fund their lifestyles, triggering taxes with every sale. They went through divorces that divided the assets further, since personal ownership meant personal exposure. They faced creditors, lawsuits, bad investments, and the slow erosion that comes when wealth is held by individuals rather than structures. The money was real, the spending was real, but the system around the money was almost non-existent. Within 2 generations, not a single Vanderbilt heir remained a millionaire by the standards of their era. The Rockefellers went a different path. They placed assets inside irrevocable trusts. They used the spendthrift clause to protect beneficiaries from their own creditors and from themselves. They layered the buy, borrow, die strategy on top of the trust structure, using loans against trust assets to fund family members' lives while the core capital remained untouched. They created a system where the money could not be spent down, could not be sued away, and could not be divided into irrelevance by each new generation's personal legal complications. 60 years after John D. Rockefeller Jr. established the family's first major trust in 1934, the fortune had not only survived across more than 170 living descendants, it had grown, not because every Rockefeller heir was brilliant with money, but because the structure was designed to function regardless of who was born into it. One family left wealth to people, the other family left wealth to a system. The difference is visible across 7 generations. B-roll Q, side-by-side family tree, Rockefellers, coherent, surviving, versus Vanderbilts, dissipated, beat 6, the deeper layer. But there is a piece of this that even sophisticated investors usually miss. The buy, borrow, die strategy does not just avoid capital gains tax. It converts the tax code itself into a wealth compounding mechanism. And it does it through a set of incentives that were not designed to work together, but that produce extraordinary results when they do. Here is the sequence. The ultra-wealthy borrow against assets at low interest rates. The interest on those loans is often deductible. The loan proceeds fund their lifestyles tax-free. The underlying assets continue to appreciate inside the trust, compounding without interruption. At death, the step-up in basis wipes out the accumulated gains. The estate repays the loans, often using life insurance proceeds, which are themselves tax-free. The heirs inherit the full value of the assets at their stepped-up basis, and the cycle begins again. But there is a second layer that makes this even more powerful. The assets themselves, the stock, the real estate, the business interests, are not static. They generate income, dividends, rent, distributions. That income flows into the trust. The trust uses it to service the interest on the loans. The excess is either reinvested or distributed to beneficiaries according to the trust's rules. The result is a closed loop. The assets produce income. The income services the debt funds the lifestyle. The assets keep growing. The tax bill never arrives, and the entire machine runs automatically, governed by documents and trustees, not by the personal discipline of any single heir. This is what separates the families who keep fortunes for a century from the ones who lose them in a generation. Not luck, not talent, not even the initial amount of money made. It is the presence, or absence, of a financial architecture designed to function across timescales that no individual human being can manage alone. B-roll Q. Animated closed-loop diagram. Assets, income, debt service, lifestyle, appreciation. Assets. Beat 7. The closer. The most dangerous belief in personal finance is that the tax code is a neutral set of rules that applies equally to everyone. It applies equally, but it does not apply symmetrically. The person who earns a salary and pays taxes from every paycheck is following the same law as the person who borrows against assets and pays none. The difference is not in the law itself. It is in whether your financial life is structured to align with the law's incentives or to sit directly in its path. The ultra-rich are not smarter than you. They are not harder working. In many cases, they are not even better at investing. What they have is a system, a legal, fully disclosed, centuries-old system of trusts, credit lines, and tax provisions that converts wealth from a static pile of assets into a self-funding, self-protecting, self-compounding engine. The question is not whether you can build a $50 million stock portfolio tomorrow. The question is whether you can begin building the architecture around the assets you do have, however modest, so that the system protects what you accumulate rather than letting it bleed away to taxes, creditors, and the slow friction of personal ownership. Buy, borrow, die. 3 words, 1 strategy, entirely legal, and sitting in plain sight for anyone willing to look. If you want to understand the specific structures, the trusts, the family offices, the legal jurisdictions that make this strategy work across generations, hit subscribe. There is always another layer, and the next one goes somewhere most people have never looked. Silence beat before 3 words, 1 strategy.